The best returns this year has come from the semiconductor companies.
Yes, they have. And indeed, those are exactly the companies we reduced in the second quarter.
So why did we sell the best performing companies? Well, it makes sense that when the valuation goes way ahead of the business fundamentals, we reduce exposure because the risk to reward ratio is going down.
Yes, exactly. So this is the risk management what we've been practicing for years now. And we don't want to be chasing for maximum returns if there's too much risk. But let's get into the details later in the video. And welcome to Sifter Fund's second quarter report. So let's start as usual, the Sifter Fund second quarter returns. In this graph, we can see that the Sifter Fund return year to date was 18.9% in euros. Over the long term, 3, 5 and 10-year returns are 16.6, 12.5 and 13.2 on average annualized returns. And in fact, a couple of weeks ago, Sifter Fund had a 23-year anniversary. That's quite a long track for a single strategy and single fund.
Yes, and over the entire history of the fund, we have delivered 855% return after all fees to investors. And this is in fact over 130 percentage points better than the closest comparison index and over 400% better than our assigned peer group in Morningstar.
Yes, indeed, we've been able to outperform the index in the long term. However, not every single year. Now we have rebounded again after those challenging years, and this spring has been an excellent remark of that so far.
Yeah, but let's not forget this has not been an easy year so far. We had a major war escalating in the Middle East at the beginning of the year, which is now looking like it's starting to dwindle down into peace terms.
Yeah, that's correct. Let's now look at the main contributors in the second quarter. The strongest stock price gains in the Sifter Fund in Q2 were Applied Materials, Lam Research and BE Semiconductors.
All of these companies are in the semiconductor industry. So they have in this quarter been enjoying a very strong demand from the build-out of data centers. There has been a cyclical turnaround from going to a cyclical downturn into a very strong cyclical upturn. And in addition, especially with memory chips, there's been a massive shortage of those types of chips. And that is signaling to us that there will be a lot more investments into new production capacity in the future.
And do you know that the fourth best performer in the second quarter was West Pharmaceutical Services, which was, by the way, the loser in 25 when the share price went down quite a lot, but now it has rebounded. Is there any specific reasons for that nice rebound?
Well, the business fundamentals has turned to the better. So especially when we talk about biological drugs and especially GLP-1 drugs for weight loss application, there has been a strong demand, and West Pharmaceutical is selling to these companies the rubber component that goes into these injectors. So the strong recovery in revenues has indeed been a positive signal to the market.
Coming back to the semiconductors, and which were the best performing companies in this quarter and also this spring, but we've been investing in semiconductors over a decade. So we've been lived through many cycles before, but it seems that this cycle seems to be longer and even stronger. But maybe, who knows when, but this cycle will end also. What do you think?
Well, every cycle sometimes turns downwards, and that's especially true for the semiconductor companies. That's why we have been selling them in this quarter and also in the previous quarter.
But we still have a nice position, and we'll come back to that later in the video, right?
Sure.
Let's move to the detractors of the fund, meaning the bottom performers. This time we had Tomra Systems, Northwest and Costco. Is there something in common with these three companies which didn't perform that well in this quarter?
Well, with the case of Tomra System is more of a idiosyncratic risk factor, or rather the fact that it has three operating divisions. One of these is regarding recycling machinery, and that division has now seen a downturn in the end user demand, leading to lower revenues and lower profits. That's why the share price has been punishing Tomra this quarter. On the other hand, when we look at Northwest and Costco, which are typical retail stores, we don't see the same level of effect. In fact, in Q1, these were really strong performing companies because they are seen as defensive companies. They're a safe haven when there is turbulence in the world.
Right.
And during the war, of course, these were then being allocated towards. But now, when we have peace terms in the Middle East again, or hopefully at least, we can see there's been a market rotation away from these defensive companies into, for example, chip companies.
So now we have covered the top and bottom performers in this quarter, but let's get a bigger picture, which are the 10 biggest companies in the portfolio at the moment. And by the way, the 10 biggest companies are over 50% of the whole portfolio, so each of them has a big meaning, right?
Yes, and these 10 companies are, in order, Safran, Alphabet, Microsoft, TSMC, Lam Research, Applied Materials, Canadian National Railway Company, and the new entry to the portfolio, Allegion, alongside Deutsche Börse and MSCI.
Couple of observations we can take from this table here. There you can see the date or year when we invested. So many of them have been in a portfolio a long time.
Over a decade.
Over a decade, right. And the second observation would be that there you can see the return since the investment.
It's quite crazy to think about, but Lam Research is up 4,600% or so. It's a 46 times return since the initial investment in 2016-17.
Yeah, that's really crazy. Maybe one more interesting point from this table is that over 80% of the companies in the top 10 are business-to-business market leaders. And why do we like those business-to-business companies over the business-to-consumer companies?
Well, we value predictability in the earnings above all else. And when you have a business making a deal with another business, you can analyze that relationship and understand the business rationale behind it. And that makes the earnings much more predictable over the long term. And that's why we tend to tilt towards B2B companies, because they are, for us, easier to understand and model for the future.
Yeah, that's definitely one. And the second thing is the pricing power. We have learned over the years that business-to-business, B2B companies tend to have better pricing power, meaning that when there's a high inflation, those companies are able to raise prices above the cost. And that's also really interesting, but also important for the margins.
Yes, price increases are a free option to increase your net bottom line.
Yeah.
It doesn't cost anything extra to raise your prices.
Yeah.
It just flows all the way down to the bottom line.
Yeah. And the third observation is, if we look at those companies, there are many technology companies and industrial companies, which are very often B2B companies too. So we tend to prefer technology and industrials. But now we could move to the changes we made in the portfolio. And we didn't sell anything out of the portfolio in this quarter. However, we invested in 2 new businesses. And the first one is totally new to us. It's called Allegion. So could you a little bit describe what does Allegion and where it's from and from in which sector?
Well, it's a company that's headquartered in Dublin, but it's really an American company. They are selling locks and security solutions to the American market, or North America as a whole. And a very close comparison to Allegion would be ASSA ABLOY, which is perhaps a little bit more known globally. And they're also a more global player, whereas Allegion is only focusing in the USA. And that's what we like about Allegion. So it's more focused on one market. It's better able to concentrate on their customers there and grow organically over the long term as well. I'm not saying ASSA ABLOY is a bad company, but in this case, we prefer the smaller company with a clearer focus.
What kind of growth avenue you see for Allegion, and how is the market now, the industry in the sector where it operates? How would you define that?
Well, the unfortunate thing about Allegion is that it's exposed to the construction cycle, which is today anywhere in the world basically in a down slump due to high interest rates not really stimulating construction activity. That's also why it's at an attractive valuation at this point in time. However, Allegion still gets a lot of revenue from institutional clients, schools, universities, hospitals that are improving their security solutions. And that gives a stable and growing revenue stream for the next 5 years. And on top of that, if the construction cycle turns around, then there's an optionality for even faster growth in the future.
Okay, interesting. So we will tell about allocation more in the coming videos, but let's move to the second new investment, which is, by the way, an old friend to us.
Yes.
It's called VeriSign.
We had VeriSign from 2016 and we sold it in 2024. Why did we sell it? Well, the core engine growth driver for this company is the number of domain names in the world, especially .com domain names. And that was growing for the first 30 years quite nicely, but in 2024 around there, we started to see a decline in the year-over-year usage of .com domain names. Why? Well, there's been slow demand in China, and you can also argue that the internet started to consolidate to only a few sites like Facebook and the like. So demand was slowing down, even turning negative. However, in the last 4 to 6 quarters or so, this has again turned to the more positive side. Last quarter, we saw 4% growth in domain names.
Yeah. And on top of that, there's VeriSign is able to hike prices 4 to 7% per year on average.
Yes, so the total revenue growth for the company can be up to 10% per year over the next 5 years.
Yeah.
And the reason why we now see demand again is, of course, the Chinese economy is recovering. VeriSign has invested more into new customer acquisition, but also the fact that these new large language models or AI models can now allow anyone, even me, to create my own website without any coding skills.
So are you planning to have your own websites?
Not yet, but I could if I wanted to. It would take me 10 minutes tops.
Yeah, that's correct.
So that's unlocking a new growth driver for the company, and especially the demand for .com domain names.
Yeah, interesting. So it is possible that VeriSign is one of these AI optimistic or AI opportunities, so to say.
Yes, you can see concrete evidence already happening there.
Interesting. And VeriSign, by the way, is a typical quality example in the Sifter portfolio. It's a capital light business. There's a very high margins, not only gross margins, but operating margins as well. High return on invested capital. But the most interesting part is the high barriers to entry. It's basically monopoly in its own business.
It is, yes.
Based on the agreements or contract.
It's a US government-regulated monopoly. If you want to buy a .com domain name, you have to buy it through VeriSign.
Yeah. So, beside these new 2 investments, we didn't sell anything entirely, but we reduced certain positions, as already mentioned, semiconductors. So we reduced the weight in BE Semiconductor, Lam Research, Applied Materials, and Texas Instruments, and Old Dominion Frightline. Then we reallocated that capital to more attractive companies like Allocation and VeriSign, as already mentioned, but then also Northwest Company, ADP, Microsoft, IDEX, Safran, Cintas, and Tomra Systems. So what was the reason for that?
The reason for selling semiconductors is quite simple. The valuation grew very rapidly in this quarter. For example, Applied Materials and Lam Research both doubled in the quarter. Doubled in 1 quarter. So even though the business fundamentals obviously went to a better, more rosier direction, the risk of us not being able to forecast the future is higher today. We don't have the same level of visibility that we had, for example, 2 years ago.
Yeah.
So it makes sense now for us to reduce exposure to these high-flying names. We then allocated this capital to ADP and Microsoft. They have been beaten down by this SaaS downslam that we have seen in the last year. And from our point of view, we do believe there will be a lot of disruption due to these new models. But Microsoft and ADP, we don't really see the threat as being credible in these cases.
Yeah, even though those both of those companies are exposed to this SaaS and software technology, however, we know those companies much better because we've been investing in those for years now, and therefore we felt quite certain when we increased the position in those.
That's right.
How about the other Costco and the Northwest and the Tomra? What was the reason for increasing the position in those?
Well, the simple answer to that is they offered us a more attractive risk-adjusted earnings potential for the next 5 years. So that's why we allocated money from more expensive companies to more cheaper companies.
So in a summary, we could say that we were quite active in the second quarter, by rebalancing the portfolio and being a little bit risk averse. That may be the main message what we did, and that gives us kind of like a more certainty for the second half of the year. Many investors want to invest in Sifter because we are a global quality fund. So let's look at what is the current geographical and sector allocation and what kind of changes we have made over the 6 months now. So what were the main changes in sector allocation?
Well, the main change is that since we sold a lot of semiconductor companies this quarter, the technology exposure has gone down. And because we acquired Allocation, which is an industrial company, and also reallocated capital to other industrial companies, that has then gone up in the portfolio.
That's correct. Financial services are a little bit down since the year to date, but the main reason is that the share prices have come down in those companies, so we haven't been active selling or reducing the positions there.
No, it's just purely short-term volatility.
Yes. So, and the rest of the sectors are very similar to the year start.
And that's also true for the geographical allocation. Not much change has been done there. We still have 2/3 of portfolio in North American companies, and the rest is in Europe and Asian countries.
Yeah. But the most important thing when it comes to geographical allocation is not the headquarter. It's where the revenue comes from.
Indeed, and in this case, Allocation is a bit of an anomaly because most of their business is in the American market, but they are headquartered in Dublin. So in one sense, it's a European company, but it also gets all of its revenue and profit from the US.
If you think about the many US-based semiconductor companies, where does the revenue come from?
Taiwan, Korea, and some in China.
So they are US companies by headquarter, but the business is outside of US very often. So therefore, it's not so important what is the current allocation in US or anywhere. Moving to the final topic, that's the valuation. Many investors ask from us, what is the current valuation of the fund, and are you too expensive since the share price has come up quite a lot since the year started? In this table, we can see a couple of things. First of all, you can see the green line there. That's the Sifter Fund NAV. So in the last 5 years, Sifter Fund NAV has risen more than 80%. So it's a really nice gain in a share price gain. Then you can see the orange line. That's what we call earnings yield. And that's our valuation metrics. But at the end of the day, we have been able to keep the earnings yield metrics on the historical levels. And why is that?
Well, the reason is that the earnings growth, which is a key input to the earnings yield, has grown as fast as the share price appreciation as well. So we can say that this increase in the net asset value of the fund has not been driven by multiple expansion, but rather than the good profits growing year over year from our underlying companies.
That's correct. And on average, the Sifter earnings has risen 13.5% per annum for the Sifter businesses. And that's very close to our NAV appreciation on average last 5 years. So it's earnings growth at the end of the day which drives the Sifter Fund performance. Thank you very much for watching the video and report again, and friendly reminder that all the examples and company names are only examples of the Sifter Fund investments. Those are not intended to be any kind of investment advice. We wish you excellent summertime, holidays, and hopefully also good investment the second half of the year. Thank you.